Understanding Obligatory Reinsurance, a comprehensive guide. Obligatory reinsurance, also known as automatic treaty reinsurance, is a significant facet of the insurance industry that often goes unnoticed by the general public. However, it plays a crucial role in managing risk for insurance companies. This article delves into what obligatory reinsurance is, how it works, its advantages and disadvantages, and the types of reinsurance available. What is obligatory reinsurance? At its core, obligatory reinsurance is a treaty established between an insurer and a reinsurer where the insurer is compelled to automatically send all policies that meet specific criteria to the reinsurer. This automatic acceptance of risk allows the insurer, the cedent, to transfer part of its risk portfolio, thereby decreasing the potential financial burden that might arise from a large claim. The reinsurer is obligated under the terms of the agreement to accept these policies without the need for the insurer to inform them of each individual transaction. This arrangement is beneficial for both parties, allowing insurers to cover themselves against certain risks while providing reinsurers a steady inflow of business. The mechanism of reinsurance. Reinsurance is often described as insurance for insurance companies. Insurers reach out to reinsurers to share the risk associated with their portfolios. When an insurer issues policies, they undertake specific risks associated with those policies, which, in some scenarios, can lead to substantial financial obligations. By entering into a reinsurance agreement, insurers can mitigate their risks and protect their financial health. The payment that customers make for their coverage, known as premiums, is shared between the insurer and the reinsurer under such arrangements. Advantages of obligatory reinsurance. 1. Streamlined risk management. Obligatory reinsurance simplifies the risk management process for insurers, as they automatically cede predefined classes of policies to the reinsurer. This eliminates the need for case-by-case negotiations. 2. Cost efficiency. Such treaties usually lower administrative costs because they don't require extensive negotiations for each transaction. Insurers can benefit from economies of scale. 3. Enhanced financial stability. By transferring portions of risk, insurers can stabilize their financial status and avoid the potential pitfalls of large claim payouts. 4. Long-term partnership. It fosters enduring relationships between insurers and reinsurers, with both parties working collaboratively to assess and manage risk. Disadvantages of obligatory reinsurance. 1. Lack of selectivity. One critical downside is that obligatory reinsurance eliminates the option for insurers to selectively cede risks. This uninhibited acceptance increases the risk of large losses to the reinsurer, which may become unmanageable. 2. Potential for insolvency. Reinsurers may inadvertently inherit a substantial amount of high-risk policies that can lead to insolvency if claims exceed expectations. 3. Reversion of risk. If claims exceed what the reinsurer can cover, the ceding insurer may find itself responsible for the associated loss, placing it in a precarious position. 4. Complexity of risks. The inherent complexity of the risks involved means that both parties must fully understand their liabilities and potential losses, making thorough due diligence crucial. Types of reinsurance. Reinsurance can generally be categorized into two main types: facultative and treaty reinsurance. 1. Facultative reinsurance. Facultative reinsurance involves the ceding of specific risks or contracts. Each risk must be negotiated individually, allowing reinsurers the right to accept or reject each proposal. This approach is especially beneficial for addressing unique or high-risk scenarios where bespoke arrangements are necessary. 2. Treaty reinsurance. Treaty reinsurance, on the other hand, covers a predetermined set of risks for a defined period. This broader approach allows insurers to cede entire classes of business without individual negotiations, which can result in significant administrative efficiencies. Special considerations in reinsurance contracts. Reinsurance contracts can be further categorized into proportionate and non-proportionate arrangements. Proportional reinsurance. In proportional contracts, reinsurers receive a percentage of all premiums written by the ceding insurer. In return, they cover a share of the losses in accordance with pre-agreed percentages. The reinsurer also covers some administrative and acquisition costs, providing greater financial predictability. Non-proportional reinsurance. Non-proportional contracts are structured such that the reinsurer only pays claims exceeding a specified amount, known as the retention or priority limit. This model allows the insurer to retain a certain amount of risk, which can be advantageous in certain scenarios. Conclusion. Obligatory reinsurance serves as a critical mechanism in the insurance industry. While it offers significant advantages, including streamlined processes and financial protection, it also carries substantial risks that necessitate careful management. Insurance companies must conduct thorough due diligence when entering obligatory reinsurance treaties to ensure that both parties' interests align and that they can effectively navigate the complexities of risk sharing. As the landscape of the insurance industry continues to evolve, understanding the intricacies of reinsurance and its implications will remain vital for insurers, reinsurers, and policyholders alike.